All right, we got about 2.5 minutes until we get started with the last second, Sunday night quick stock market scan. A little busy tonight, but definitely gonna hop on because I feel like we have a good amount of stuff to talk about. All right, we've got 1 minute to go until we get things started for the upcoming week. And to be honest, I kind of got everything set up that I need to get set up. It's almost 11 o'clock Eastern. Let's just skip these last 35 seconds and jump into it. So for the very few viewers we have, thanks to the last second announced stream, thanks for tuning in. I need to update this to be week of 3-6 really quickly. There we go. I guess I should have taken those last 35 seconds. Jules, how we doing? Long time no talk. All right, so here's what we got set up for the upcoming week. But as you can see, it's been a tough year for us so far, right? We're down 18% overall in the year, but transparency is one of the biggest parts of what we're doing. There's going to be good weeks, there's going to be good months, there's going to be great years like what we had last year, but there's also going to be bumps in the road like what we've seen so far in 2022. Now, we are having this bump in the road as a result of some pretty tough movement in the market. This is definitely a tough market to trade. And, compared to how the S&P 500 is performing, we're still kind of hanging in there, to be quite honest with you, right? We definitely have been a lot closer to outperforming. We have had, periods during the week where we had been outperforming the S&P 500 on the year, but as the dust settles headed into March, we've got a little bit of a hole that we need to climb out of. But again, we could scroll back as long as we need to for the that 2021 summary to look back and say, hey, we know this strategy works. We know it's a long-term approach that we have set up. One rough month in the form of January so far is not going to be enough to completely shake us off our strategy. We're going to get back to this. We're probably not going to be breaking even in the next month or two, but I think a good short-term goal is to kind of flatten out our profit curve a little bit and get back to outperforming the market, step one. And then, we could look ahead to potentially breaking even on the year. And I've always said, it's great when we have years like we had last year, where we had about 100% return and the S&P 500 returned 27%. But at the end of the day, our goal in the market is just to outperform. So we could finish this year in the red, but as long as we have done better on a percentage basis than the S&P 500 has done, I would consider that a win for us. But let's quickly talk about last week. Some big red numbers between Affirm and Roblox, which really dropped off at the end of the week and kind of crushed us, right? A $13,000 loss between just those two positions right there. And if you actually look outside of that, even though it was a tough week in the market, we didn't do too terribly outside of those two Affirm and Roblox positions. So just the nature of the strategy that we're in and how we're trying to manage these positions, they are larger parts of our portfolio right now. And, if you look at the week before that when we made $17,000, we derived $8,000 of profit from that. So that's just one of those things that's kind of how it is. We're kind of living and dying with a little bit of Affirm and Roblox right now. but we did take some steps for the upcoming week to mitigate that a little bit. But those really are where a lot of our losses, and quite frankly, the bulk of our losses on the year are coming from. Without Affirm and Roblox, we are damn near breaking even on the year. So if you avoided those trades that we jumped into, congratulations, you're probably doing great this year, but that's just the reality of the situation. We're in these and we are going to find our way out of them. But that's where a lot of the loss came from. And, a common theme on a week-to-week basis is that we've been adding these positions kind of below the longer-term positions that have been scraping together a decent bit of profit. For example, last week we have 569 right there. The week before that, we had $830. The week before that, we had $440. Week before that, we had, $1,000. Not huge numbers, but on a weekly basis, if we're adding these smaller positions and pulling $400, $500, $600 a week, that adds up. That's $26,000 a year. And if you actually look at our trade performance so far on the year, which is messed up because something's being divided by zero, whatever, I'll fix that later. All of our losses, we have some pretty steep losses, right, from Affirm and Roblox. But since, what's this date right here, January 13th, when we entered into a Virgin Galactic trade, aside from this credit spread that we lost on SPX, we have actually hit on every single trade that we have entered into. That is 35 different trades that we have entered into since mid-January. New trades, that is, outside there's Affirm or Roblox. And those have all resulted in a profit. So the great part about our strategy, right, we repeat so often, is that once these trades are over and done, these profits are locked in. You can't take that away from us. We've got some big red numbers from trades that we have from, earlier in the year in the back end of 2021. But eventually we are confident that we're going to be able to get those back to break even. And once those get back to break even, we will have that break even performance combined with all of these cumulative gains from these other new positions that we've been opening up. So I think at the very least, we've done a good job here in the fact that we have such a high win rate on these new trades in what has been a really tough market to trade is also part of the logic behind some of the moves that I've made for the upcoming week. So I think a lot of us know what happened last week, and I think it might be a little bit more productive just to talk about this upcoming week, because this is going to include a discussion of how to manage our losing positions in addition to what I've been looking at for the upcoming week in the market. And the biggest difference in what we are holding heading into the week is with Roblox right here. You'll notice last week with Roblox, we had the 70 strike puts that had an April expiry. And with $25 of premium in Roblox trading at about 40, what was it trading at market close on Friday? Let me check. Roblox 42.29 is what it closed at on Friday. So these basically didn't have any extrinsic value left. And at that point, you really just have a glorified stock position. And why did we like Roblox so much? It's because of the combination of how it looked as an investment opportunity and the amount of premium that it was offering us. And when we have something that doesn't have a lot of extrinsic value on it, it's really not offering us any premium. So we decided to step out of that trade and roll these Roblox puts down to 44 strike. Now here's the consequence of that if I go over to the Roblox tab. The consequence, as you'll notice over here, is that unfortunately we can't break even, by the end of this upcoming week on Roblox. I need to update this with the next two positions that we have, and we have a pretty steep loss on this so far. However, we're kind of theoretically, I guess proverbially, excuse me, I guess it's getting late early. We're proverbially hitting that reset button, meaning that, okay, we're going to take break even off the board for the next month or so, and we're just going to focus on making the best trades that we can every single week. Because what happens so often is you could fall into a little bit of a sunk cost fallacy where, like we had with Roblox, we had this really, really big position at 70 strike, and we had already cut it in half to reduce risk a little bit, and that definitely helped us. But we could reduce it a little bit further and roll those strikes down to make it even safer and take advantage of some of that option premium that we talked about. And that's what we're going to focus on. Now, this originally had a 4/14 expiry. April was when we initially intended upon exiting the trade. But, we've been in this for just over 2 months. The stock has dropped 55%. So obviously there are going to have to be some difficult decisions to be made along the way. Because anytime you have a bullish position and something's down 55%, you're not going to be in a great position, quite honestly. However, we have certain strategies, ways to mitigate that to where I think we could try to crawl back in And let me actually fill the rest of this out for you live here so we could demonstrate what exactly we did, right? So these ended the week at 15, and the others we got out for 25.75, and then the 44p we got out for 150. So we already have 25.75 up there. We got out of these for 150, and this is going to temporarily make the loss a little bit bigger. But what we did for the upcoming week is we rolled our 50 strike puts down, so that's going to be 8 Roblox 50p that expire 3/11 50p. And then we also, similar, so we rolled the row 5 right here down to row 7, and then we rolled row 6 down to row 8. So we again sold 7 3/11/44 puts. And I guess I don't really need to type Roblox there, but let's get those numbers. What did we sell those new ones for? We sold the new ones for $791 and $277 respectively. So $791 up here, $277 down here. Let me cross these out, copy and paste the values. Actually, what did we close the 50 strike puts out? Let's make sure we have the right numbers in there. We closed this out for $771, so that was correct. Come over here, paste those values in. Okay, so these are our new positions, and let's just throw zeros in as placeholders right now, just to kind of show you the idea we have with hitting the reset button here. And I'll go over to the Palantir tab in a second, because that's another area where we hit the reset button. So there you have it with the 0 placeholders in here, right? And this is what Roblox would be trading at. I guess this is what we would be looking at if Roblox bounced back up to 50 a share. We would take home a profit on the week of $8,200, which on a week-to-week basis, that's a fantastic number. And then we would be down to a $14,000 loss. So this is helping us a little bit, right? Because when we're looking at a loss of $22,000, to be quite honest, we're not going to make that back in 1 week. And further, we don't want to put ourselves in a position to make that back in 1 week, because that kind of a position is inherently a very risky position. And the biggest goal we have with our strategy, the biggest thing we could do for ourselves if we truly do believe in a long-term approach, is protect our capital and make sure that we're alive to trade tomorrow. So you've got something like a DraftKings trade right here, which is, we'll talk about this in a minute, but we have all these different legs right here. We have the GHIV trade that we like to reference so often, where we have 29 different legs, and we ended up coming out on top with an $11,000 profit. So, you know, this is a 27-week trade as well. It took about 6 months, where Roblox, we've only been in it for 2 months. So this one is still young, relatively speaking, and one of those where I'm confident in the process that we have set out to recover from it. It's not going to be something where we recover tomorrow, but I'm confident one day we are going to be able to look back at this as proof of concept and say, okay, remember how bad things can get? Because, you know, for a large cap stock like Roblox, dropping 55% in about 2 months is a huge drop. People who are invested with leverage in Roblox are getting crushed. People who bought calls on Roblox are getting crushed. But we, thanks to our option selling strategy, have a way to get back to even, albeit, you know, it might take a few months for that to materialize. But, you know, at a very, very base level, right? If we put 791 and we put, oops, that was page up. And we put, where's the enter button? 277 back in here to zero out the profit and loss. So we know that if we are assigned these shares, right? Let me pull the calculator up to kind of illustrate the idea of what we're doing. We'll remember that we first started this trade with an April expiry with a 66.2 break-even price. Now, if we were assigned on the 50 strike puts, we would get those assigned at 50 net of the credit. So it'd be 50 minus 7.91, meaning we would get these shares at 42.09. I'm just going to write that here for reference, 42.09. And then the next shares, right, the 44 strike for 277, 44 minus 2.77 means we get those at about 41.23. So 41.23 plus 42.09 divided by 2 to get the average means if we were assigned these shares, we would have, you know, a basis right now of 41.66 just on these two. So with the basis of 41.66 and 1,500 shares hypothetically, how much would it need to go up for us to make $23,000 back? So and again, 41.66 would be our average. Let's write that down here, 41.66. So the way we want to look at this is, you know, we have a $23,000 loss. We have 1,500 shares. meaning we need to recover $15 per share. And that's $15 off the average of 41.66. So the way we could actually look at this now is that if we were assigned on these two options that we've sold, we now actually have a 56 break-even price. So while initially we started with a pretty large position, these were initially combined for 15 at a 70 strike, where our break-even was 66.2. By cutting this trade in half and actually starting to do some of these things we've done on a week-to-week basis to manage the trade, we've actually lowered our break-even price a full $10 without even, I would say without even doing anything. I should say we've lowered it a full $10 without even having to wait until that original expiry, right? It's the beginning of March right now. And we initially would have had to wait another month or so to further lower that break-even price. So that's kind of the idea that we have right now, is that if Roblox does continue to drop and, say we do take assignment on the shares, which we won't, we're going to continue with the cash geared puts, but just for following out the logic of the idea behind what we're doing here and rolling these strikes down, this is what our break-even price would be. And while it sucks because, a 56.9 break-even price on a $42 stock is a pretty significant loss. That's what we're looking at right now. But it's, one, better than the 66.2 we started with, and a hell of a lot better than the 95 that Roblox was trading at when we started this trade out. So, and again, it's only really been, a couple months in this trade, and we've already done this much damage to our break-even price. Roblox just last week, it was above 50 for a second before it fell back down. But the fact that it's moving up and down so quickly, volatility works both ways. There's nothing stopping this from going back up to 50 by next Friday, and then we could be looking at, this being worthless. We could look at this being worthless, and we could be looking at a $14,000 loss just like that with 1 week, behind us. So that's kind of the situation we're in right now. We're making objectively better trades, right? Because if Roblox trades flat for the upcoming week, this will only be worth about $1.70. This will be worth roughly, 7.8-ish. And we'd be taking home roughly $1,000 of profit right there just from Roblox trading flat. Whereas if we held on to those 70 strike puts that we had before, that would not be the case. Now, moving on to trades, I think we can talk about another trade that's gone pretty poorly in the interest of transparency, right? Palantir. This is another one, right? We started this thing at 24.8, but you'll notice week by week by week by week, we have whittled down this break-even price and hitting the reset button. And I come to talk about Palantir because it's really similar to what we did with Roblox, where we hit that reset button. We got to a position right here in our notes where was it? I don't even know if I put it in the notes, but we were in a position where we couldn't break even, right? So we had 2,000 shares, and we had 1,000 here and 1,000 here, just to help you guys kind of follow the madness that some of these trade breakout tabs can become sometimes. But we had the shares for 13.8, and obviously we're sitting on a loss. And our break-even price at that time was about, high. It was between, looks like just under 23 a share, which is pretty significant when the stock's trading at $13. And that $13 per share was a full pretty much $10 below what our break-even price was. So we said, hey, let's take a step back. Let's hit the reset button. Let's get rid of this, and let's just open the same size, right? So we had 2,000 shares, so we sold 20 cash secured puts, but let's do it at 13.5 instead of just continuing to hold on to these shares. Because as you could see, we wanted to be a little bit more mindful of that downside risk. We had 2,000 shares that dropped from 13.8 to 10.96. Had we held on to those 2,000 shares, that's a roughly $3 drop per share over the course of 2,000 shares. Would have been a $6,000 loss if we had held on to these shares. But since we hit that reset button, if we tally up all the profits right here, and it's a slight loss, it's a $320 loss, but a $320 loss is a hell of a lot better than a $6,000 loss that we would have incurred by continuing to hold on to the shares. So by hitting that reset button and just starting the trade over and just trying to take chunks out of the big loss and eventually have patience and confidence that we'll get the train kind of close to even, it saved us $5,700 just over the course of the last month. And that's something that we're going to continue to work our basis down. And as you could see, when we hit the reset button, we had a basis of around 2283. This is when we took assignment. But now, beginning in March, we're sitting at a break-even price of 17.72. And obviously, that's, we still have a long way to go to get back down to that share price. I guess we have a long way to go since the share price is around 11 a share. But, this just the idea, right? You sell the covered calls that you can. You try to take about 25 cents off it. And, my favorite thing to do here, we talk so much about the long-term approach and just being patient with your trades. Palantir's dropped 55% on us. That is not normal price action. But the fact is, we're still kind of hanging in there, and we could get this thing back to break even, right? Our current break even is 28% below the price that we entered Palantir at. I mean, even over the course that we've been in this trade, which has been about 2-3 months, even a 28% drop over 3 months is pretty significant. Yet our strategy could handle that. We're really only sitting on a loss because it's gone in excess of that. But let's follow the logic, right? We keep trying to take 21 cents off, 10 cents, 27 cents off of our break-even price a week, right? And if we're able to take a quarter, meaning 25 cents of our break-even price, 25 cents off of our break-even price every week, and we do that for, the next 3 months, which is about 12 weeks, all of a sudden we've taken another $3 off, and our break-even is $14.72. If you extend that and say, hey, let's take 25 cents off per week over the course of an entire year, you've dropped your break-even $13. So if we're still hanging with this trade a year from now, and we continue to take that average of 25 cents off our break-even price per week, we're going to be sitting at an average of $4. And I mean, there's no reason that if we stick with these trades long enough that we can't actually have a zero break-even price on some of these. And we've talked about Roblox. We've talked about Palantir. Those have both gone terribly. DraftKings is another one that has dropped a ton on us. But you'll notice here, we are almost back at break-even, surprisingly enough, on DraftKings, which has been awesome. And it has been a product of us following that mindset that we just kind of laid out on these Roblox and Palantir trades. DraftKings at the bottom, I think, got down to about $16.50. So, a steeper drop than this. But again, keeping in mind, we started this trade with DraftKings at 36. It's dropped 42% on us in, 14 weeks. That's about 3 months, which is an insane drop. It's been about 2.5 months, and it dropped 42% on us. Yet, our bullish position, we're still able to almost break even. Our break-even price now is $21.56. And we're not going to be able to hit that this week because we're capped at 21. But the idea here is similar to Palantir. The numbers are a little bit bigger because DraftKings is a little bit more volatile. But we've been selling kind of in the money or at the money covered calls to get as much premium as we can per week. And it's really paid off for us. Just over the past 2 weeks, we were able to take $2.36 off of our break-even price. And that is really phenomenal. I think if we pull this fill handle down, these are the amounts that we've taken off our break-even price week after week after week. And since mid-January, we've taken an average of 68 cents off of it per week. And if you wanted to pull that calculator up and take 60 cents off a week for an entire year, that's roughly a $30 reduction in break-even price. So I think all things considered with this DraftKings trade, we have incurred a big loss or I guess a big drop in the stock, yet we haven't incurred a big loss on our overall trade. And that's thanks to these covered calls that we have been selling, thanks to this option selling strategy that we've conservatively employed to help protect us against the downturn and volatility in the market. And we're going to continue to do that, right? I think the question we get at the end of each week, Thursday and Friday, when we look at rolling these trades into the following week, especially for DraftKings, is, what strikes are we targeting? With our quote-unquote conservative approach by selling in the money or at the money covered calls, we've done some serious damage. And with how volatile the market has been, I want to continue to be conservative with these covered calls. So selling at the money, I think, is my plan until we have the basis below the stock price, right? When your basis is below the stock price, you're making money on the trade. So until we get to that position, I want to stay as conservative as possible. I want to take as much out of our break even as possible per week. And then maybe, a month or two from now, if we have our break even down at like 19 or 18 and the stock's trading at 20, then we could maybe start to get a little bit aggressive and say, let's sell these covered calls $2 out of the money and try to hit a little bit of a rebound here. Let's get a little bit more aggressive and, week by week, walk it up. because, our gains on the shares are capped at 21, which would lead us to an overall loss, but a very small overall loss if it does get back to 21, right? If it gets back to 21 this week, we're only looking at a $1,000 loss on the trade. Now, if we're able to walk this thing back up to I guess the idea, right, is to extend the covered calls higher and higher and higher, similarly to when you're selling cash secured puts and you want to roll down and out. When you're selling covered calls, you want to roll out and up for a credit to, one, increase the amount of premium you're collecting, and two, increase the potential gain on the shares before they're called away. So, week after week, if, we're able to walk our call strike up $1 or $2 and eventually get these things called away at 28 sometime down the road, all of a sudden, this is a 5-figure profit for us, despite the fact that even if we get them called away at 28, we're making a 5-figure profit despite the fact that the stock has dropped over 20% since we entered. And I think I cannot pull up a better example of why we do what we do than what you're looking at right here, right? We took a stock that we liked. We took a bullish position. Huge drop, but in spite of the huge drop, right, we're still hanging in there. And if we're able to hang on long enough for it to rebound just a little bit, right? We're not even asking for a rebound back to where the stock was when we started to play. We're just asking for a rebound to get it to minus 22% from when we started. And that still helps us take home $13,000 of profit. So strategies like that, remaining conservative, that is kind of how I plan on getting back in the game, so to speak, this year, right? We're hanging decently below there. The futures, I think, for the S&P 500 are looking a little bit red right now. I've got them on another monitor. They're minus 1.39%, which is, just terribly frustrating. Don't get me wrong. It is a pain in the ass when the market looks like this, especially coming off a year in 2021 where the stock market was just pretty consistently and steadily heading upwards. There wasn't really a lot of adversity. Really only 3 months in 2021 where the market was red, and the reddest of those months was 1.41%. And so far in 2022, you can see we haven't had a single green month yet in the market. And the minus 7.79% return in the S&P 500 is nuts, right? And, not to flip back to that tab, but we did see that the biggest red month in the S&P 500 was minus 1.4%. We almost basically had that last week in the S&P 500, right? We did have that 2 weeks before that, excess of that the week before that. If you look at some of these S&P 500 return numbers, it has been a bloody, bloody year so far in the market. But take solace in the fact knowing that, we haven't really blown up, right? Our account's back down to 147K. We're down a good amount of money, right? We're 18% is nothing to sneeze at. However, we're down to 147K. If you look at 2021 again, we were down at 147 back in August is what it looks like. So if you look at where we were in August, 147, and you look at where the S&P 500 was in August, 442, the S&P 500 is lower than that. The S&P 500 is back down to about 428. So that means, we've outperformed a little bit since August of last year, right? It's never fun to lose money, but again, our performance is always relative. So VIX is your friend right now. There we go. We've got IHW poking into the Twitch chat, and I think he is about to make his return to the market. So excited to see some of what's going on with that. But again, to that point of how much volatility in the market, what's going on with VIX, we really want to do our best to make the best trades on an individual basis week to week, which is why we got out of the Roblox 70 strike puts. Very little extrinsic. We put them down near the money. We're trying to get as much premium as we can. And, taking advantage of these high premium conditions, high volatility conditions, is what is going to help you survive the volatility in the market, right? We did it really well with SoFi. We sold 8.5 strike puts. Some of these earning trades that we got into last week, really good ways to give yourself some huge amounts of credit and fight some of the volatility, right? We opened Lemonade 17.5 strike puts, and let me take a look off screen really quick to see what Lemonade is trading at. Actually, let's pull Thinkorswim on the screen here. We entered into Lemonade 17.5 strike puts not even at the end of last week, back on March, right? Not on March, on Thursday of last week. And despite the fact that on Friday it went down 4%, which is a decently red day, it's still $2 above where we need it to stay. So that is the advantage you could give yourself, right? And we only sold these things for, let's see, 25 cents. They're now trading March 11th. These things are trading for almost double that, right? These things are going for about low 40s. And if you want to get a similar credit to what we got, right? We got 25 cents. You can get 25 cents down at, 16.5 now. And 16.5 is a $3 cushion on this stock for the upcoming week. So it's one of these things where if the market is really, really red, you have the opportunity to say, I'm going to give myself objectively a 1.54% ROR, which on a week-to-week basis is a fantastic return. And two, I'm going to give myself that return. I'm going to make money just as long as this thing doesn't drop 15% on me in 1 week. And, these types of conditions in the market, while it can be tough because you're going to be looking at some losses sometimes, which is the reality of what's going on, and that's currently our situation. But when you're looking at this much volatility, you're looking at some very good opportunities to objectively open trades, right? And as we mentioned at the top of the stream, a lot of our losses are from, the older, longer trades, the Palantirs, the Fubos, the DraftKings, the Roblox that we've been rolling out. If you actually look at the trades that we have entered since the volatility really started kicking up, we have a roughly, almost 100% win rate on these trades. So there's a lot of really, really good opportunity to give yourself some really, really big cushions. Enter into things like this and, help support your account as it's bleeding out from the others. Because as we've outlined with DraftKings, right, you could bleed out a ton. And I think at one point, these were worth 16.5. We hadn't sold any of this premium yet. Like we were looking at like a $15,000 loss on DraftKings maybe a month ago. Actually, probably shorter than that ago, right? I think after earnings, when did DraftKings go down to 16.5? Let's zoom out here really quickly for the purposes of this little example. There you go. It was down to 16 back on February 22nd. But here's the deal. You hang with it. It rebounded to 25. Volatility works both ways, right? It could drop really quickly, but then it could run just as quickly back up to 25. But we don't care so much about the day-to-day, right? We set our strikes. We set our trades up. At the end of the week, we roll our positions. And, we just let the numbers fall where they may. But again, when this thing was trading at 16, we were in a world of hurt. Again, we hadn't really sold any of this premium down here yet. And we were looking, there it is, a $17,000 loss when this thing dropped down to 16. But did we panic? Absolutely not. Because at the end of the day, it's just a numbers game. The price of the stock isn't going to go down forever. Stocks go down, stocks go up. But one thing that is a consistent is the fact that we could make our break-even price drop week after week. And we went from this $17,000 loss to just 2 weeks after that getting it down to a $1,700 loss and potentially being in the driver's seat depending on where DraftKings finishes up this coming Friday to actually make profit on this trade despite a 42% drop in 2.5 months. And again, this is the bread and butter of what we do. This is why we do what we do. Markets are getting crushed. This stock got slaughtered, yet here we are able to break even. And, we loved DraftKings at 36. We love it a hell of a lot more down at 20. So even if our shares do get called away, we're happy to start the process all over again and start selling cash secured puts on DraftKings. So if it does keep running back up to the mid-high 20s, we're going to profit from that as well. But that's kind of the plan. That's why we don't panic. That's why we stick with some of these trades. When you see something like a Palantir where we're losing $13,000 on it, again, look at that break-even price. We're dropping this thing week after week after week. And we're also, one thing that I am considering and I think would be really interesting to kind of outline here on the stream, I'm thinking about potentially doubling down on this trade, right? We know with the HT wheel position sizing, advice, you typically want to start with about 50% of the total trade, which is what we did when we sold 10 cash secured puts. We then doubled that to get up to a size of, 20 cash secured puts or 2,000 shares to get to what we would consider to be a 100% position size. However, when things can get really, really dire, I don't hate the idea of, once again doubling down should your buying power allow for it. And as of right now, we're unfortunately tied up in a firm Roblox, DraftKings, Facebook, Open Door, Fubo, you name it. However, if we could get out of a couple of these trades, such as if we can get this DraftKings position called away in a couple weeks, or if Roblox rebounds, even if Palantir rebounds, or Fubo rebounds, if we could just free up a little bit of buying power, let me demonstrate right now how effective doubling down is when you are looking at your break-even price, right? So we've already done a pretty decent job, all things considered. This thing's dropped 55% on us. Sometimes these stocks just drop faster than we can handle. But we've gotten a break-even price from 24.8 down to 17.72. Now, why am I looking at potentially doubling down? And here is the answer, right? We're going to run through this same exercise. Say we wanted to double down with 10 strike puts, and if we go over to Palantir, PLTR, oops, I can't spell Palantir because my keyboard is not lit up and it's dark in my room right now. There we go. Let's say we wanted to double down, and when we double down, right, we have 2,000 shares, so doubling down would get us to 4,000 shares. We never want to just buy shares, right? Because what is our favorite way to acquire shares? Our favorite way to acquire shares is by selling cash secured puts. So here's how this shakes out, right? Not only are we currently selling, the 11.5 strike calls for the upcoming week, which netted us 27 cents a premium when we did it. Since we want to double down, we would then also sell 20, maybe 10 strike puts, which are offering about 20 cents per contract. And the great part about this is you might say, HT, I want to double down. What if it doesn't get down to 10 and I don't get those shares? The great part is that you would get that premium. And since you sold it at a 1-to-1 ratio, meaning you have 2,000 shares and you would sell 20 10-strike puts, that premium you sell is a dollar for dollar or cent for cent reduction in your cost basis of Palantir. So not only would you get this 27 cents to drive your break even from 17.98 down to 17.72 on a weekly basis, you'd also be getting this additional 20 cents to drive it down to not just to 17.72, but down to 17.50. And all of a sudden, we go from a position where we're selling about 25 cents a premium a week to a position where we're selling 50 cents a premium per week. And every 2 weeks, theoretically, we knock $1 off of our break-even price. So a month from now, this break-even price would be 15.72, provided that Palantir didn't get back down to 10. 2 months from now, this break-even price would be 13.72. And we'd be heading into May with a $13 break-even price on Palantir, which is well below the initial price we started at in November of 24.8. And that's not to say that we're going to be breaking even at that point, because 13 is still above where Palantir is trading right now. But it is to illustrate how effectively you can deploy some of these option selling strategies. Because look, if you have a stock that you're playing at 24.8 and in November, and by May you could potentially have a basis in the 13s, that is a very effective strategy. And again, that 13 basis might not get you profitable, but if you can go from November of 2021 at 24.8 to May of 2022 at 13, imagine what you could be looking like in November of 2022, even below that 13 number. So the point isn't that, we pick these short-term targets and say, okay, on X date, we're going to have this basis and we're going to break even. It's more to say that, look at the progress we've made on our basis so far, extrapolate that out X amount of months, and we're very comfortable about where we're going to end up, despite the fact that we have a big red number right here on our current profit tracker. But again, that is just extrapolating the example of selling 25 and 25 cents. What if you got assigned those 10 strike puts? Well, we know that we have our current shares at 17.72. If we were assigned 10 strike puts with a 20-cent credit, that means we would get those shares at $9.80 and average those out. We would now have a basis in 4,000 shares of $13.76 just next week. And again, that would necessitate the stock trading under 10. But all of a sudden, by doubling down, we've knocked our break-even price down from $17.72 to $13.76 in just 1 week. So that is, a really good example of how when some of these trades start moving away from you, one, if you think the stock's going to keep going down, just get rid of the position. There's no need to keep sinking money into a losing position. But we are of the opinion that, look, if you're entering into something at 24.8 and it drops, to 22 in the next week, why? And that's enough to scare you away. Why were you really in that position in the first place? We like to enter these positions because, in general, we believe a lot of them are decently oversold when we get in. A lot of them are primed for a rebound. That doesn't always happen, right? You could run into a situation where all of a sudden Fed decides to start hiking rates. There's a global war going on, and, all these things start tearing the market down. And you could say, oh, that's just terrible luck. And quite frankly, it is bad luck, but two, it is a reality of trading in the market. Things are not going to be nice and easy and flat, and the S&P is just going to return 10% every single year. That's just not what happens. So what you need is a strategy, something like this, to help manage that volatility in the market. And even if the market is moving down and your holdings are showing a loss on paper, you can rest assured knowing that, even though we entered into Palantir at 24.8, I don't need Palantir to bounce all the way back to 24.8 now. I just needed to bounce back to 17.72. And if I use this double down, I would really only need it to bounce back to 13.76. And then maybe 2 months from now, I've sold even more premium and I only needed to bounce back to 11. Or maybe at that point, it's even above 11 and I've now made money despite a 50% drop in a stock. And that is really the idea and theory behind the HT wheel strategy that we're running. So that's a good example of why doubling down is a really, really effective way to lower that break-even price. And one little piece of self-criticism, because it's always useful to reflect on what we do. We're not always perfect. I think, the strategy gets tweaked and perfected every single day. We make mistakes. And I think one mistake we made here, especially, seeing how a lot of these stocks that we've been in have played out, is in our minds, we saw Palantir drop from 33 to 24.8 before we entered. We thought, okay, this thing had been bouncing around the mid to high 20s for a decent amount of time. I'm perfectly happy to get in at what appeared to be the low end of the channel on Palantir. But what we didn't really anticipate, and I can kind of pull up the chart to illustrate this a little bit over the last year or so. Here we go. This was the range it was kind of bouncing around in, and from June 30th last year when it peaked at 27, bounced off 21, back to high 20s, back to mid 20s, back to high 20s, and then it had a really big gap down. And we said, okay, I think this big candle right here is where we entered. We said, okay, pretty big candle, probably going to hit support here and bounce back up. And it did hit a little bit of support for a second, but not long enough for us to get out of the trade. And, what we underestimated was how quickly this thing could fall down. It's really easy to fall into the trance of watching a stock bounce back and forth in a range. And we just didn't really anticipate this kind of a downward move. So I think the one piece of criticism that I would give myself for, one, this trade, and two, a couple of the other trades that we find ourselves in a decent hole on, is wait to double down, right? We just demonstrated how effective doubling down is when managing your break-even price. But you lose a little bit of that effectiveness off the bat when you double down so early. And I've kind of tried to do that a little bit with this new open door trade that we had, right? We jumped in at 9.10. And I could pull open door up to show that this one had a similarly heartbreaking drop for us, right? Look at all these red candles over the last 20 days. There you go. So what happened back on February 24th, we can quickly tell the story of this trade. They reported earnings after hours. They didn't look terrible. But then the very next day, there was a huge candle at open, right down to about 9-ish. And it's one of those things where we said, okay, earnings weren't catastrophic. There's a big red candle. It's probably just people dumping after earnings. That's fine. That's normal. Typically, we see a rebound from that. And we eventually did see a little bit of rebound. We sold 8.5 strike puts, and we got out of them here, unfortunately. And by got out of them, I mean we rolled them to the following week to manage our position. Had we held, they actually would have been profitable. But, that's neither here nor there. But we rolled them out another week and got ourselves into this position, right? Here's the initial trade that we sold. It was the day of, right? Because this was a Friday right here. This little day with the big red candle was a Friday. We said, okay, the stock's at 9. We could sell an 8.5 strike put, and as long as it doesn't drop another 10% intraday, we're going to make money. However, it did drop another 10% intraday. But again, we like these Friday high volatility trades because we could just quickly flip that around, right? Our initial break-even price was 837. It dropped to 670 at one point, and that's what we quickly flipped the trade around by selling an 8-strike put. For the following week, we rolled the position down, we rolled the position out, and we didn't quite roll it for a credit, but we rolled it for a 9-cent debit, and we decreased our strike by 50 cents. So overall, it's a 41-cent benefit to us. So that got it down to 7.96, which again, that's a pretty rapid decrease in your break-even price. But of course, again, we could see, especially last Friday, this thing was a heartbreaker. It was trading right around our break-even price. Something about open door and Fridays just does not bode well for us. But again, this thing was trading right around our break-even price. We thought, okay, we're looking decent. But by the end of the day, The thing had dropped all the way down below 7 a share, which was a nasty, nasty Friday slide. But again, it's something that we could handle. So what we did was we wanted to be patient. I think the purpose of this was to try to show to be patient with the double down. And we were off the bat by rolling down to just 8. But as we rolled down to 8, we eventually just took manual assignment of those shares at $6.95, sold covered calls, which got the break-even price down 21 cents, and then we doubled down by going into that covered strangle at 6.5 for 26 cents a premium to get a full 47-cent reduction on our break-even price. And you see that right there, right? So last Friday on 3/4, we took our break-even price from $7.96 down to $7.49 by doubling down. And again, this isn't quite the full impact, right? Because we had shares at $7.96. Actually, the easier way to do this would be, look, our double down, quote unquote, was to sell 6.5 strike puts, which we sold for 26 cents of premium, meaning if we get assigned these shares, they're going to be assigned to 624. The first batch, so to speak, of 1,000 shares that we had assigned, those had a break-even price of $7.96. So plus $7.96 divided by 2. That would then give us an average of $7.10 on these shares. And then you could also take away that 21 cents that we sold on the covered calls, meaning that if we get assigned on these 6.5 strike puts, we now have a break-even price of $6.89. And that is very, very effective, break-even price management. And I think, our hand was shown a little early by having to double down due to just a really, really sharp drop over an 8-day period because, it says 17.58, but that's just because I'm putting 7.5 in here to show my break-even price. If you actually have the ending price on Friday, do I have to put quotation marks here? I think I do. Yeah, the stock has actually dropped 25% on us in 1 week. That is such an insane move, especially, what you could kind of consider to be non-earnings, because earnings had already come and gone, and then it continued to drop past that. Normally with big earnings moves, you see it all after hours, right? We saw it spike up to 12.24. And imagine my surprise seeing something the previous afternoon get up to 12.24 and thinking, 8.5 was going to be safe the following morning. But again, goes to show a maybe more important lesson that there's no such thing as free money in the market. But even when things turn against us, with the option selling strategies that we have, we could manage it very, very, very effectively. And while we're currently sitting at a loss because open doors at 676 on shares that are trading at 749, we know that if it does continue to drop further and those 6.5 strike puts are assigned, our overall position is going to have a 689 break-even price. That's perfectly fine. I'm not too worried about that. And 689 break-even price would fall exactly where the stock is right now. And let's say it stays above, 6.5 for the upcoming week and stays between the strangle that we built at 6.5 and 7.5, which in theory is what's supposed to happen most of the time. Because again, we shaved 47 cents off of it right there. There's nothing that stops us from doing the same thing next week, shaving another 40 cents. And by, next Friday, March 11th, we'll have a $7 break-even price. And if it's trading at $7, just like that, ta-da, we have finally gotten the break-even price below the stock price. But high volatility ticker, low strikes at 6.5, so it's not a huge position. So I think a good one to kind of show this example of being patient with doubling down. And while we did have to double down quicker than we would have normally liked, let's say this thing finishes at 7.5 almost on the number next week. We could just not sell cash secured puts again next week and go right back into selling covered calls, keep moving that break-even price down, and keep that additional cash secured put double down in our back pocket for another time if it keeps going down. So while, it is easy to try to follow some sort of systematic diagram that we've laid out with the HT wheel, it is a lot more fluid in practice, and this is a great example of that. So that's what we got for the upcoming week. We've got Robinhood as well at 9.5 strike. Just another one that gives us a massive cushion, right? The thing closed at $11 last Friday, even after a minus 3.69% day. And, we're sitting safe and sound at that 9.5 strike. So, if open door, everything hits the way we want it to hit and things just trade relatively flat, right off the bat right there, that's $3,000 in profit for us. And again, we love the idea of evaluating our positions on a week-to-week basis by playing out this scenario of what things would look like if they finished flat, right? We know Roblox would be about $1.80 right here. There you go, right? So we would get a roughly 2.37% return, and that's even wrong because that's using last week's denominator. It'd be slightly bigger. So it'd be about a 2.5% return just if stocks traded flat for us this next week. But, they're minus 1.3% in futures. That's not to say that next week's going to be red, but it definitely looks like tomorrow morning's trending in that direction. But again, keep the buying power light. These numbers are entirely wrong because I just quickly updated these before we went on live. So I will update these at some point soon. But, be mindful of that buying power. I think open door, even now, if you don't have a position in open door, fantastic amount of premium available right there. And as IHW's pointed out right here in the chat, 100% IV. And we love plotting the IV right here. If you back out to the 1 year chart, there you go. IV rank 73, IV percentile 98% right there, right? You could see, historically speaking, for open door over the past year, that implied volatility, this blue line that we plot right here, is getting very, very high up. And combined with another metric that we love to look at, RSI, is also getting back down there. And why do we love RSI? Because let's look how RSI has historically been as a short-term price predictor. The last time it was in the red, meaning it was oversold, it eventually tapered off. Last time it was in the blue, meaning red overbought. Did I misspeak? Maybe I misspoke. Red's overbought, it went back down. The blue means it's oversold, meaning, you could potentially expect a short-term jump in the price. And there you go. You saw a bounce from 8 to about 11 over the following 2 to 3 weeks right there. So we love the intersection of high implied volatility along with a low RSI, because you could have a high implied volatility, with relatively mid RSI, and it doesn't really tell you too much, right? After this one, it kind of fell off the face of the earth. But when you have high implied volatility and then get down to a low RSI, right? So a little bit of a spike right here, lines up with that blue, the blue RSI. There you go. Because not only does that predict a short-term bounce, you could also use the heightened implied volatility to get greater break-even prices, and giving yourself a big cushion combined with that theoretical short-term rebound is a really, really great setup. And that'll be a fantastic segue into some of our options scanning. Let's take a look really quickly at what we have for the upcoming week as I take the chat back off screen. Here we go. So the first thing that we like to look at, right? High ROR puts without earnings. So let me load that in there. And if you want to have all of these preset scanners like we have right here, hourglass-trader.com. There you go. Self-plug. 3 seconds and it's over. So high ROR puts. I hit the wrong one again. It's getting late. Sorry. Without earnings. There we go. So I'm going to throw the scan in there. And again, this normally is going to give you a pretty large amount of results, right? We have over 1,000 options for the upcoming week that offer insanely high RORs. Anything above, what's the minimum right here? Minimum 1%, right? Because 1% is what we like to look for on a week-to-week basis at a minimum. Because 1% compounded annually over the course of a year gets you to like 60-something% return annually, which is just nuts. So, the theory is that if you could put half of your buying power into 1% ROR on the year, you're on track to get, a relatively decent 30-ish% return on a year with only using half your buying power. But again, we see that stocks go up, stocks go down. It's not going to be an easy profit every single week, but with the heightened implied volatility in the market, there's some very, very high percentage opportunities out there. This one may seem like we're hiding a losing trade, but CTIC is actually about to be a winner. I just need to put link the actual cells up. So what do we see at the top of the list? We see RSX, which we successfully played last week for a solid $90 profit. Don't spend it all in one place. But, we loved that one just because, one, it can get a little bit boring seeing out some of these longer-term positions, and maybe you want a little bit of excitement in your life. RSX undoubtedly is provided that as a Russian ETF, and we all know what's going on with the Russian stock market. It has been closed since all of these sanctions have been levied onto Russia. There has been fears because, Russian stocks trade in other markets. I believe the London markets also hosted some Russian stocks, which have, effectively lost almost all of their value. So, the Russia ETF is kind of on life support here. And because of that, you are going to see some fantastic ROR numbers, right? This is just obnoxious what you're seeing right here, right? We like 1% ROR. You could sell a 2-strike put on RSX for the upcoming week, and there's volume here, right? These aren't just weird bid-ask spreads. These are as tight as it gets, 5-cent wide bid-ask spread, 1340 of volume right there, and that's a 10% ROR. So if you are trying to ride the lightning, interesting opportunity right here. However, the caveat and the reason that I personally will not be touching this again is because it's a Russia ETF. And there are a couple other Russian ETFs that as of last week were delisted from the market. And when a stock is delisted from the market, you do not want to be an option seller on that stock. Now, typically what happens is they'll say, this stock is going to be delisted effective March 18th. And then, of course, your March 11th expiry would slide right under the radar and you'd be good to go. And again, it's not all downside bad news, right? There's premium on the calls up here, right? There's a 13-strike call, which would be an over 100% return on this ETF, which is trading for 20-ish cents with some volume right there, right? So it's not like it's all doom and gloom here. The options are priced for just a big move, period. But there are definitely some risks that you want to be aware of. So do not, enter into this trade with money that you cannot afford to lose. Because even the 4-strike puts that I sold last week got a little bit dicey at one point on Thursday, right? When the thing opened up at 784, and I was like, all right, this is going to be a nice, easy trade. And all of a sudden, within, an hour, it was down at 5. And I said, okay, wait a minute. This is not as easy as I thought it'd be. But again, as is the case most of the time with the option selling, it's a high percentage trade. It's going to work out for you more often than it does, and that one worked out for us. But if you are playing it past last week into this week and beyond, definitely be aware of that delisting risk. I haven't read the prospectus or anything like that, but I have heard stories of ETFs where they just liquidate and pay out net asset value over the fund when things kind of implode. No idea what net asset value of this fund is right here. Let's see if there's any conversation about this thing in the news. There you go. All these Russian ETFs were halted indefinitely for regulatory concern. So that is a little bit scary right there. You do not want to be involved in that. However, typically option sellers come out okay when stuff gets halted because, the stock price doesn't move and you're not going to exercise a 2-strike put if the stock was halted at 565. But huge, huge, huge risk, and that's a question mark that I would not like to leave up to chance. So staying away from that one, back to the results of the scan. We've got UVXY, that's a volatility instrument. We don't like to play volatility instruments. USO is US oil, I believe, and that is an interesting one because price of oil has been all over the place. Might be a very good place to, get a little bit of diversity in your portfolio because oil has been shooting up as the market has been absolutely collapsing. And in fact, I remember USO being a very, very cheaply priced stock. Let's go 3 years back. There you go. At the bottom of the COVID crash, this thing got down to $16.88 and has been a fantastic investment since. But maybe a decent hedge against the market if you're really, really concerned about something like a $200 barrel of oil, which I don't think is a realistic possibility unless some sort of macro factors change. We've got IHW. Let us know if we really want a premium chase. Take a look at UCO. And guess what? We take suggestions from the chat. So let's take a look at UCO. Pretty much... it looks like double the price of that. Almost looks like a 2x USO type ETF. But if you want to look at some premiums, right, we love 1% ROR. Where's the volume come in here? There we go. Some huge, huge, huge premiums down here, right? You can get 1% ROR roughly at the 140 strike. And that 140 strike, if you look at the last 20 days of trading, so the last trading month, falls right around here. So there's definitely some downside to this. And that's why I'm not a huge fan of a lot of these ETFs. Especially the leveraged one. This is a 2x leveraged ETF. Definitely a little bit scary because if these things start going down, the idea with our strategy is that you want to be comfortable taking assignment of the stock. You want to be comfortable, investing in the stock and holding it long term. And I am not comfortable holding any of these leveraged ETFs long term because more often than not, they do not end that well. But back to the other results of the scan, and typically, this is the way a lot of these things go. Towards the top of the scan, you're just going to have these insanely volatile names for certain reasons, and a lot of them are not going to be good investments. Now, however, definitely some interesting names that we see right here. Carvana. Is Carvana CVNA? What's CVNA? What do we got right here? It is Carvana. Tons of volatility, right? And why is that? Oh, my goodness. Because they had earnings on February 24th. I guess they went from 123 up to 150 before going back to 102. I mean, that almost seems like something that necessitates some sort of news here. What? Price target at 360, price target 167, price target 140, price target 130. I mean, that's probably when all of this started happening, although these price targets were released on February 28th. The big drop didn't happen until March 3rd. I'm not seeing anything that would really, explain away this severe of a drop. Let's zoom out the chart a little bit to the 180 day. And there you go. You've got a very, very good entry point here, right? We like to talk about RSI. We like to talk about implied volatility. Implied volatility is skyrocketing over the last few months. RSI is back down to the blue. And again, why do we like the blue so much? Last time it got this low, it jumped from 106 up to 160. And the time before that, we had a little bit of a short-term bounce. Time before that, short-term bounce. So this one might be a good one if you could find a significant amount of premium, right? And let's make this a little bit suspenseful. We've got the ROR column right here. We're going to slowly scroll up and see how low we could go and still get 1% ROR. We're still going. We're down into the 80s. 80 is the number. 75, you can get 0.9% ROR on a Carvana 75 strike put. And, maybe a little bit of a wider bid to ask spread, but this is where a limit order is your friend. Stick something out there for 67 cents, and you'll find a trade where it would have normally taken $75,000 of collateral, 10% margin requirement. So that means you can multiply that ROR by 10 to get your ROC and basically set yourself up with a 9% return on your capital so long as Carvana does not drop 25% this upcoming week. That is some insane value. But again, look, this thing went from 376 in August down to 100 this month. So do not put that kind of a move out of the question, right? And we've seen a lot of this this pattern that we see right here, right? We have early 2020 or late 2019 peaking right around 100-ish. Then we see the COVID drop down to 22, and we see these huge runs, which eventually make what I'll call quote unquote a round trip trade back to the pre-COVID highs. And typically we see bounces from around there. So if you plot 75 on this chart, which is where that 1% ROR shows up, and extend that out to the left, you see a pretty good value proposition right there, right? You would, if assigned, have shares of this stock trading right around where it was pre-COVID. I think Square is a good example of one that has followed that path, right? All these pre-COVID highs of around 80, drops back down, explodes up, and then, gets crushed the front end of 2022, back into 2021. Where does it bottom out? This candle literally bottoms out at 82.72. The high here was 87.25. I mean, so you are getting some pretty accurate bounces just based off where the pre-COVID high was for a lot of these stocks. And I think, what else? We use this similar theory with Zoom, actually, right? We sold 85 strike puts for earnings, and then it never even got that low. So it's a really nice setup, and I think we could use that to our advantage here with Carvana. Using one, the huge implied volatility to our advantage to sell super far out of the money and get a decent cushion. And two, use this idea of the pre-COVID highs as a little bit of support. And again, you've started to see it a bit, right? This big candle stopped for now, right around those pre-COVID highs of about, the low 100s. So I actually really like the idea of a Carvana 75 strike put at open. Again, we've got that market maker move of $10, which is, pretty materially lower than the expected move of 15, but both of which, even if you use the expected move, which is 15, that would put you at a low end of the range of $88. That's still $13 in excess. You would need something 2x the expected move to get you down to that 75 strike, and I really, really like that value proposition. So I will definitely have my eyes on Carvana 75 strike puts at open tomorrow morning. Another thing that we got on here is a firm, which we are just, left for dead in. They've got some really, really decent option premium because the volatility is absurd, right? We had a stock, and I can make the candles a little bit more digestible by going to the 180 day here. But again, this thing was trading. It IPO'd, traded around 60s, 70s. So you know what we did? We sold 55 strike puts off the bat and said, that would be a good place to own this stock. It was previously at 176. It's coming back down. RSI is getting lower. Implied volatility is creeping up. But little did we know this thing was just going to completely rip our hearts out and go back down in the low to mid 30s. Our situation with that one is we are currently sitting on the 50 strike put, which gives us a break even of 48.46, 4 lower, thanks to a little bit of manipulation of the position here, but 4 lower than when we first started the trade. But again, the stock has dropped 55%. I feel like this is almost a cruel magic number for us, right? Roblox, 55.48. Affirm, 55.79. Palantir, 55.81. Is there anything that hasn't dropped 55% on us? Maybe we should have known. Maybe this was a sign. But regardless, if you're looking to get in on a trade, you can get some absurd premiums, right? If you want to go a month out and really take advantage of this, you can get a 20 strike put with a decent amount of premium, right? This is, 5-ish weeks away. And again, we like to target 1% ROR per week, which would be a 5% ROR for something 5 weeks away. You could sell a 25 strike put on a firm and get that. That is down here. That is a strike no one on planet Earth, or that is a price no one on planet Earth currently has a firm at. So there you go. You'd be holding a firm at a world record low price, which is not a bad place to be. I mean, the company's generating revenue. There are some concerns about growth, but again, where can you look? A lot of the price targets are still holding. There you go, $65 price target, $77 price target, $50 price target. So the price targets are still in excess, significantly of where it's trading at 35. So one of those things where, we only have so much time to sit and dig into company financials and look at, trends and things like that. The analysts who set these price targets, it is quite literally their jobs to do that. So if you have a decent consensus that a reasonable price target on a firm is somewhere 50 or beyond and our break even's 48, I'm okay with that. I'm going to stick with that trade. And looking forward, even if you wanted to sell premium back up at that 50 level, right, for something a month away, you could still get a little over $1. And I think our plan would be, look, if we had to roll this trade, we know that selling covered calls and selling cash secured puts at the same strike is essentially the same trade. So we'd be able to roll our 50 strike puts down and out a month to hopefully 45 for $2 of extrinsic value, meaning that would lower our break-even price by $2. So the idea for us right here, I think, in the short term, when we do get to March 18th, is one, hope to God we get a bounce on a firm back up into the 40s to make this a little bit more manageable. But two, the idea is that we're going to roll down to 45 strike puts and hopefully line up that 45 strike with a 45 break-even price. And you might say, okay, but you cap your gain. You might not make any money at all. But we don't want to fall into that sunk cost fallacy, right? We're at an $18,000 loss on a firm right now. If we can get that back to zero, that will mean in the next month we make $19,000 on a firm. That sounds good to me. For us to even have the opportunity to break even by April on this thing after it's dropped, again, 55% on us, is phenomenal. And that is just what we are going to play out. So I'm happy to keep rolling a firm. That's what we're going to be doing. But if you are not in on a firm, some very good opportunity to take advantage of a dropping or a lowering RSI. And again, last time this RSI got into the blue, we saw it bounce from 31 up to the low 40s. It's getting back down again. IV is still elevated. Take advantage of the IV before it starts to level off and those premiums start to go away on you. But again, a firm, very good entry opportunity right there. And that is really kind of the only other big one that sticks out to me. Let's see. We got DraftKings in there. We're already playing DraftKings. There's some fantastic premium right there. Lemonade, LMND, great premiums there. We talked about that a little bit earlier in the stream. None of these that look phenomenal to me. Shop is definitely an interesting one because that is one of these companies that is just pumping out revenue. However, has had a really, really significant drop in the market over the last 180 days, right? This thing has been cut by I wouldn't say cut by a third. It's been cut by 2/3 into a third. going from 1762 back in November to 598 right now. Implied volatility is still very, very elevated over what it normally is. With that price coming back down, let's take a look at the 3-year real quick to see where we might be able to come back down. Pre-COVID highs look like they're about, here we go. They're about high 500s, and it's trading at 600 right now. So in theory, we should be starting to reach that pre-COVID high, and we already got an initial bounce off of it. So I could potentially see Shopify steadying out a little bit at these levels. So let's take a look at what we could potentially sell for the upcoming week. Where can we get that 1% ROR? And oh my goodness, we can get it at 530. That is that's insane. And I believe this is one of those stocks that offers you a decent little bit of buying power privilege, right? Now, this is one that is absolutely cost prohibitive because a full position, if you're assigned on just one cash secured put, it's going to be $52,000. But if you're part of the margin gang and you're looking for a good way to stretch out some of that capital, only tying up $5,300 for a $520 return in a month or in a week is a 10% return on your capital, and that's fantastic. This may also be a good example of a trade where you could use that idea of selling, something further out, right? And we know that the theta decay curves are a little bit different for something that's 60-ish days out. If you go out of the money for something about 60 days out, the theta decay curve actually accelerates a little bit, and you could go down to 355, meaning as long as this stock is not cut in half by May. I don't really know what these would be trading at. This is a little bit tighter of a bid-ask spread, so maybe somewhere around here. But you could sell one of these and take home a profit of $970 for $3,600 in collateral. So that's a great example of a potential longer-term cash-secured put that you could sell. If you're not patient to wait 75 days, maybe wait just 47, and you can go all the way down to 400, the lowest strike they have. And again, you see a pretty decent, I sold 10 of those. Whoops, let me go back to one for purposes of showing. But there you go, $850 return off $4,000 of capital is going to be roughly a 20% ROC in about a month and a half right there. So not a bad figure there at all, but again, a great example of how we can use, the combination of low RSI, the combination of high implied volatility, combination of, potentially reaching those pre-COVID highs to get in on what would be a fantastic basis if assigned, and two, a really, really tough basis for this thing to reach. It would literally have to be cut in half again down to 360. 360, it falls here on the chart. Let's extend that out to the left really quickly. And that is a fantastic price, looking at the last 3 years, to own Shopify at, like a powerhouse in online retailing. So I think that's a fantastic trade idea, the Shopify 360 strike put, and that might be something I take a look at market open. We have a pretty significant position in Roblox. Maybe I reallocate some of that into Shopify and learn from my mistakes in the past, right? We got crushed on a firm in Roblox because we started out with pretty large positions. We altered that by starting Facebook with just one contract. And I think a similar setup would be starting Shopify with just one of these contracts. So that's definitely something I'm going to have my eye on at market open. Maybe not market open, but if we do see a continued pullback in the market, have a little bit of buying power, I consider these to be a little bit of a safe haven, right? Because if the market collapses and things drop 10, 20%, guess what? You really have a roughly 50% cushion, which is just insane to say for something as big as Shopify. But you do get this cushion down to this red line by the month of May. And this is a 3-year chart. So you might say, oh, it's falling pretty quickly. Right here is the new year. So May would fall kind of where this cursor is right here. You have a very, very big cushion for a very small period of time, relatively speaking, for something like this. And RSI says this thing is primed for a rebound, the first time in the last 3 years that it's been down in the blue. And, the other thing that's so interesting is you might say this is a 75-day trade. This is a lot of time to wait. The great part about this is that since it is a bullish position, and if we're correct, this thing rebounds up to 800 plus, and the implied volatility consequently drops off, this is going to be worth a lot less than $8 for the option. You could conceivably, in a week or two, take home 50% of max profit, throw that cash in the bag, and move on to the next one. So that's what's also so great about some of these longer term cash secured put positions. Because one, it's nice to have a solid group of options you could play on a week-to-week basis. But two, if the market starts shitting the bed, so to speak, you want to have a bigger cushion on some of these trades so you're not sweating your entire weekly portfolio, right? A big drop in the market hurts weekly positions, absolutely, but it's nice to have something in the back of, kind of in your back pocket, right? If you had Shopify May 330 strike puts or something like that, market could go down 2% next week, but you say, okay, these things are still alive and well with very little danger. So I think I might look to add one or two of the 300-ish strike puts for the month of May for this coming week. I think that's going to be a really, really nice trade setup. But we've looked at those. I think maybe one quick thing we could do is go to our high ROR puts without earnings, intersect that with our oversold filter because we love to talk about RSI so much. And let's see what it gives us, right? We go from 1,139 shares. We use the intersect feature. And we've now cut this down to a nice 24 list of shares. And we'll look what's right at the top of that. Shopify, right? So using this intersect feature is a great way to get a more focused look and go from, an option scan that gives you 1,000 plus results to something that gives you some more focused, really, really nice setups from the perspective of what we like to look at, right? SKLZ is at the top of that. Let's take a look at SKLZ. Finished at 251 on the bat. We could sell 250 strike puts for, let's see. We sell them for 16 cents, which is a monstrous 7.3% ROR. However, more interestingly is if you see that there's premium at the money, especially this much premium, there's probably a little bit of premium further out of the money. That's exactly what we see with the 2-strike put. And it might sound absurd to try to sell an option for 3 or 4 cents of premium, but you could sell a 2-strike put, which is all the way down here, and that gives you that 1.78% ROR. That's a figure that we like to look at. Is there any margin help right here? Not really. But, that's okay because you're getting a really nice cash secured return. Let's go back to this. We already looked at Shopify, WW, Weight Watchers, I think. Really nice setup. We popped this thing back to the 180-day chart. RSI is getting back into overall sold territory. Implied volatility is up there. But again, one of these that I don't really know where I think this would stop falling. Maybe at the bottom of this candle from back at the bottom of COVID, right? This is the COVID low. The COVID low was 975. It's at 908 right now. What does premium on this look like? All right, if you could get 10 or 15 cents on an 8-strike put, you take that. That's just a numbers game right there. Let's go back to this right here. I think this is a Chinese stock. Not going to look at that. Snow is another decent one, right? We played that this week right after earnings and took home $30. Another one where, don't spend it all in one place. But again, huge red candle after earnings. Implied volatility is still relatively elevated. We could probably get a better look at that with the 180-day chart, right? Normally after earnings, you see a big drop off in implied volatility, but with how big of a candle this is, implied volatility is still kind of hanging up around there. And because of that, you can get some decent option premium. Where did it bounce last week? It bounced at 184. Can we get any premium at 184? You get 1% at 185, but honestly, for how big of a move it was after earnings going from 275 down to 184, I would not put it past this stock to get back down to that low, right? It's kind of a no man's land. You've got this big gap. You could fill it up to 238, or it could fall back down to where this candle falls at 184. I really don't know which way this is going to go. I think this might be a good one to keep on the watch list and say if it does continue to have some severely red trading days and get down to 184 again, then come back to look at it, see if we can get something at 160. But again, no need to stick a gun to your head and make a trade just because you took a second to look at a couple charts, right? We have all these decent options. Shopify looks good. Skills is interesting at a 2-strike. WW at an 8-strike is definitely interesting. And we have all these other trades that we have going for the week being. So be patient. This market is not shy of opportunities because with the amount of volatility we've seen, tons and tons of stuff out there. So with that said, that's going to be all we got, right? We've hit the hour and 20-minute mark. I did not even realize it's past midnight, but I think we had some really interesting setups, right? We've talked a lot and honestly probably beat a dead horse on a few of these positions that we've talked about managing, but we are confident we're going to get these break-even prices further down. I guarantee you when we talk to you at this time next week, they're going to be further down. And I guarantee you at some point in the future, they're going to be below the price of the stock. So we're going to stick with it, stick with that. We're going to keep, throwing these little 1, 2, 3, 4 extra trades in on a weekly basis and stacking this kind of profit up. We've done that with Lemonade, Open Door, Robinhood, and CTIC for the coming week. But, let's stick with it, stick with the plan. We know what it looks like when things are going well, right? We've seen our 2021 trade performance in our year-to-date summary. We made 100%. 2020, we made a really good amount of money as well. We didn't lose a single month in 2021. Even when the market was red, we had some green, and a lot of the, we've seen the 55% drops in multiple stocks that we've been in. So the fact that we're, kind of, so to speak, only down 17% on the year when the market is down 10% is kind of remarkable with some of the drops that we have had to negotiate. So again, we've seen that when the market rebounds, we rebound even faster, and that's due to the leverage that we're using. Just the big question mark and the big thing that we need to focus on is riding the waves and kind of making sure we don't lose too much like we did last week on those losing red weeks. Worst.o had a quick question in the Twitch chat about ERUS. General advice, stay away from the Russia stocks. There is no need to introduce that amount of risk. The volatility in the U.S. market is enough where there is plenty of opportunity, as we've discussed throughout the stream tonight. You don't need to go, finding opportunity in the Russia market because that is just way too risky. So much other opportunity out there where you don't really need to mess around with any of that stuff. But again, we've got our smaller trades lined up for the week, hoping to get some good movement on some of the larger names so we could rebound. But again, we're down 17%. The market is down 9%, and it's going to be down a little bit more with futures red 1% right now. But hey, we're only 2 months into the year right now. We outperformed the S&P 500 by about roughly, we finished at 109. The S&P 500 finished at 27. We did it by about 80% last year. So it does not take a lot of time for us to close the gap that we have created and start to pull away. So this is the first moment that we have really been underperforming since we started publicly tracking back in July of 2020. So trust the process, right? We've got these 2020 tabs in here as well. There's the year-to-date summary. We had a big losing month with Helion, which was a very big learning experience for us. But again, add it all up, that's a $19,000 profit in 2020. Add it all up in 2021, we had a $94,000 profit right there. So we're $114,000 up before this year. So us throwing away 31 to start the bat. Don't get me wrong, it sucks, but again, our performance is all relative to the market. We've used leverage, we've traded stocks that have dropped 55%, and we are still standing here to trade. So I'm so confident that, years from now, and it hopefully won't even take that long, but a year or two from now, when we look back at this, it'll be a bump in the road having this experience trading through a war, trading through a pandemic, trading through a, uncertainty with Fed rates in the market is going to make us better traders in the long term. And, ultimately what we are above all else is investors, because if these things move against us, we just take positions in the stock, we lower our break-even price, and eventually we are going to marry up our break-even price with the stock price, and everything's going to be okay. It's tough when the market goes straight down, right? Normally with a little bit of reprieve, we're kind of right back in the game, and we saw a little bit of that. But again, up, down, a little bit of a roller coaster. That's just how we're structured a bit. We've taken steps with rolling our roadblocks down to 44 strike, and, opening a few other things, selling at the money calls for DraftKings. We're trying to work on getting a little bit closer and leveling this out a bit so we don't have the big swings on a week-to-week basis. But, the best way to think about this is January was awful. It was objectively awful, but we made money in February when the market dropped. We're making money in the March with the market dropping, so let's hang in there. Just as we've been talking, the futures have gone up 0.1%, right? So with how quickly things move around, would not be surprised to see a green overall week, to be quite honest. So hang in there. Friday is a long way from Monday. I think we have a good game plan. I think we have some good stocks. We've identified some great opportunities for premium in some of the scans that we've been looking at. So let's add a couple of those into what we already have. Sit back and let the numbers fall where they may. So again, we are looking at $31,000 loss right now. It is slightly better than what we had at the end of January, but not too much better, but we are not worried at all. And it's because of the history of what we're trading, what we're holding. And I mean, I figure I'm kind of talking in circles at this point. But again, especially for those of you who are new following along or just new to the market, it is tough to lose money. It's not fun to lose money. It's good that you don't like to lose money. That will help you protect your money and make better decisions in the future. But again, with this strategy, so long as you can afford to take assignment of these shares and roll these puts we sell, eventually everything is going to be okay. And again, there's a huge personal finance aspect to this as well. If you can afford to save a certain amount of each paycheck and deposit that into the market, all of a sudden you've got more buying power to initiate new positions on these lowered stock levels. And you could build that way as well. That's something I personally do, but I do it in a separate account. I don't include it in any of this just to show growth via pure trading. But that's a great habit to have. So again, focus here is as if January never even existed. We don't want to do anything stupid to lose even more money and try to make this back at once. We're just going to play the market every single week. We're a little bit leveraged in Affirm and Roblox. I will give you that. But hopefully a little bit of green will get us back even there. And then we can just go on a month-to-month basis, taking this thing back the way that we normally do. And continuous outperformance will lead to overall outperformance from here on out. Big hole, 10 months ahead of us. Let's do the best we can. And I'm optimistic, especially with what we're doing, that we can get back not just outperforming, but breaking even by the end of the year. And that is our goal. So for those of you who have stayed on towards the end, past midnight Eastern time for our special late night weekly stock market scan, thank you for tuning in. This has been the Hourglass Trader, where as time passes, we make money. And hopefully we talk to you guys next week with this number a little bit lower than 30, and these two lines a little bit closer together. Thank you guys.